Google versus Meta. Now, the online advertising world is changing drastically right now because companies have started to pull back their spending. When you look at the survey of CEOs, they're now suddenly saying that we're all pretty much 100% likely to have a recession this year and next year. Great. Thanks, guys. Way to be reactive and not proactive. So what are they doing? Easiest thing in the world to cut is marketing and advertising. It's a joke within our companies. I always talk about how I think it's incredible that businesses will pull back advertising at the exact point they should be increasing their advertising. When other businesses are failing and going down, don't you want to get more market share? Increase your advertising spend. This is your sales force. This is the start of your sales force. Why would you ever think about pulling it back? So if you're new to this channel, I'm Paul. I'm a value investor, but I'm also a business owner. I own 8 or 9 businesses upstairs, and I think about investing the way I would think about buying a business because that's what you're buying when you buy a stock. In the world of Google and Facebook, are there headwinds? 1,000,000% there are headwinds. There's no denying that. But I also look at the world and think to myself, wait a second, this world's growing. Google and Facebook are in front of everybody in this world. At some point, basically, who has a computer? How much of the world still has to use a computer? There's still so much growth. The world's getting wealthier, and there are areas of the world that Facebook and Google haven't even been able to advertise to because when the average person is making $500 a year, and I'm exaggerating it, but when they're making such little money, how can you possibly advertise to them in an economically efficient way? But as that gets bigger and bigger, as the world gets wealthier and wealthier, that will change for Google and Facebook. I don't look at today's numbers and think, oh my God. I think to myself, 3 things. 1, is this company going to be around in 10 years? And for Facebook and Google, I think they both will be. 2, if they are around in 10 years, do I think they'll be making more revenue and profit or less revenue and profit 10 years from now than today? If the answer is more, then my third question is, can I pay a reasonable amount of money today that factors in the risks for the future where I can get an ample return on my money while I wait it all out? And if the answer is yes to that, I need to figure out what that price is. If that price is today's price, I buy something. Does that mean it's going to go up from there? Absolutely not. Look at Warren Buffett. I did a video last week where I talked about Warren Buffett's holdings in stocks. The top holdings of Berkshire Hathaway. Go look at how they've done year to date. Only one stock is up. And overall, his average stock is down about 20%, which is pretty much in line with the S&P. Because when stocks go down in mass like they have been, and they probably will go further, it'll affect everybody. But let's go look at Google and Meta, Facebook, and see how they're looking economically, because these are 2 companies that I love. So Google, guys, I remember hearing a few years ago, somebody telling me on the channel, in the last year and a half, 2 years, you can go look at our past Google videos. This guy is crazy to think that Google is going to fall below X dollars. And I believe they said what's equivalent to 120 today. Guys, the 52-week high is 152. The 52-week low is 92, and it's currently at $95 a share. And my guess is, in this bear market, it will probably go lower. Is that a for sure thing? Absolutely not. But they just reported results and it wasn't the best. The very channel you're watching on right now, you're watching on YouTube. Their YouTube revenue for the first time ever fell. But remember, they paid it was a $1 billion or $1.6 billion for YouTube back in 2006 or 7, and it currently generates $7 billion a quarter in revenue per quarter. That is a money-making machine. Let's go check out the 8 pillars on Google. Now, I love this. If you've watched our videos in the past, I love it when a company is all green on these and red on the valuation metrics, the PE and the price of free cash flow. The reason I love that is all I need to do is wait for the price to fall. Now, just because these are red does not mean the company is overpriced, right? But there are aspects of the company you have to understand. Here's one thing. The long-term liabilities relative to free cash flow. This company ain't going out of business. When you have this little debt in the company, you ain't going out of business. The market cap of the company is $1.24 trillion. It did $280 billion in revenue with almost $70 billion in profit. And last year, over $60 billion in free cash flow. How do you go broke generating that kind of cash? We don't even say, when you want to look up something on the internet, what do you say? You Google it. And you don't just Google, it's not like Kleenex where you say Kleenex for every single type of tissue. You literally, or Xerox when you want to copy anything, no matter what kind of copier it's on. You literally go to Google. The 2 largest search engines in the world are Google and YouTube. That is an incredible feat they've accomplished because they focused on the user. They focused on how do we make the user experience better for learning and finding answers for things we want. That's what their goal is, and they've done it very, very well. Name me the number 3 search engine. And you know what? I only ask you that because I have no idea, because I don't care, because I'm quite sure it's Google, YouTube, and somebody way lower than that. Tim, are you going to look this up right now? Tim, our producer, CEO, is looking it up right now for me. So let's look at analyst estimates. Google's expected to make $5.27 this year. And in the next 4 or 5 years, it's expected to go to $9 according to our analyst estimates. Now, again, these are just analyst estimates. Take it very loosely. I tend to use these as my high estimates on growth when it comes to using our stock analyzer tool. In terms of revenue, $297 billion to $455. Still high single digit, low double digit growth over the next 4 or 5 years. So still a lot of growth potential for the company. Is it going to grow 30, 40, 50% like it had in years past? No, but that's okay. Why? Because it's so stinking huge. If a company was doing $1 billion in revenue versus $100 billion in revenue, which one's easier to grow 10%? Which one's easier to double? Clearly the one doing $1 billion in revenue. That's exactly the case here. Now, let's look at what we'd be willing to pay for Google based on our stock analyzer tool. Now, I really want you, as I do the stock analyzer tool, to rewind this part over and over to understand this, because this tool is useful. It doesn't include the balance sheet, but it's a useful way of saying, is this company within the realm of possibility for me to buy, where I should do more research today? That's the main key here on stock analyzer tool. So I'm going to do my 10-year analysis on Google. You can do 1 to 20. Now for revenue growth, if you remember right here, the high revenue growth for the next 4 or 5 years, let's call it 12%. Now I'm doing a 10-year analysis, and as it gets larger and larger, it's probably going to grow at a slower pace. So I want to make sure that I account for that when I'm doing my analyzer tool. So I'm going to go with 3, 7, and 11% revenue growth. 3 is very, very low. And I want to be really conservative on my low side. I still want to account for growth, but what if there's a major recession? There are things that might happen. I don't know. I'm probably being way too conservative here. Profit margin. Now the profit margin is pretty consistent, as you can see from here. Over the last 10 years, it's 22.6. Last 5 years is 23. Last year was 23.7. So I'm going to say 21, 22.5, and 24, because they are getting into more of the Google, Microsoft, and Amazon have probably the 3 largest cloud computing, AWS, Azure. I don't know what Google's is, Google Cloud maybe. I have no idea, but those are very high margin businesses, so it could drive margins up. And as their other bets work out, Google has other bets, it might drive up profit as well. Free cash flow, I'm going to do the exact same thing, because a company like this is probably going to do very similar free cash flow numbers as profit margin as we see here. Now for PE, the current PE is 18.5, and the current price of free cash flow is 20. The question here is, what's the PE you would assign to this company in 10 years, at the end of 10 years, for a terminal value for the business? The average over long periods of time is 15 or 16 on the market. Now, you make this higher because it has a really high moat or return on invested capital and has a lot of growth potential. I don't think 10 years from now, the growth potential will be there. And that's okay. But I'm still going to assign 14, 15, and 16 PE and price of free cash flow. Now, our final metric is the desired annual return. Now, one of our users in the community made a comment to me this weekend and said, Paul, you always start at a low number here and go higher. It should be the other way around. Technically, they're right if you want to be really, really conservative. But my point is, I've already been very conservative here. So I want margin of safety on the desired return. 10% will get you what the market does. So I want a higher return. But as I make lower assumptions and go higher, I want my margin of safety to go up because it's less likely that this happens. This is a harder hurdle to cross. So I want a higher margin of safety, a higher desired return. So I'm going to go with 12, 14, and 16%. I hit the analyze button. Boom. All right. We're actually pretty close to the high end here. Low end is 56, high end is 95, middle price is 75. I'm actually going to add it to my watch list here. I'm going to add it at $80 per share. That doesn't mean I'm buying it at 80. What it means is, Paul, go take a look at it, decide if the fundamentals have changed, if something in your thesis has changed. If you like it at that price, go buy it. If you don't like it, but it's close, maybe I go sell puts to get paid to wait for the stock to fall to where I want it to go. So if you've watched our videos in the past, this number constantly changes. Why? I want to make sure that I'm not cementing myself in a previous analysis. I want to come to it clean. This number is going to change. There are other videos where I might have said, I'm interested at $95. Okay, great. The point is, I'm not coming out with numbers like 70, 180, 250, 30. It's somewhere in the high double digits. Now, the market's fallen a lot, and I believe the market has more to fall. And I probably made assumptions based on the fact that I thought revenue was going to keep it. But they hit a hurdle recently on the revenue. Does that mean I'm worried about it long term? No, but I want to be more conservative as the market's falling. I'm okay with that because I've already waited this long. Let me be more conservative. The number is going to change. Just like when you ask Warren Buffett and Charlie Munger the value of Berkshire Hathaway, they're going to say different numbers at different times. But the point is, as long as you're overall consistent, that is what matters. Don't get yourself attached to your previous analysis because that's going to show your bias. Sit there and go forward and say, hey, let me reevaluate. The point is, you want to get to the point where it's very consistently around the same. Listen, I did a stock recently with a good friend of mine, Gary, and we came up with a value of $16 and $120 a share. That's a very, very wide range, but we were comfortable with that. It's like, listen, worst case, we think 16, high case, we think 120. The 120 price has to happen though on the very peak of the cycle. And that's part of the ideas going on here. Let's look at Meta now. So going back to our main page, let's pull up Meta. Now, guys, in disclosure, I own Meta and I'm down big on Meta. And I'm okay with that because I believe in the Meta long term. I answered those 3 questions of mine. 1, do I think Meta will be around in 10 years? Yeah, they have 3.5 billion users using WhatsApp, Instagram, Facebook, Oculus, all their other platforms. 2, do I think they'll generate more revenue and profit 10 years from now than today? I absolutely do. I think we're still in the infancy of online advertising. And 3, can I pay a reasonable price today for Meta stock, assuming the things in the future that concern me? Let's go check that out. So we were concerned about Meta at 380. I started selling puts on Meta starting at 250, and I have dollar costed average on the way down. So yes, the stock is at 100. I started buying at 250. Absolutely no problem with that. And now, based on the assumption I'm making in the future, probably will show that 250 is probably the high side of the value. But that's the goal here. I dollar cost average down. As the thesis changes, do I still want to own Meta based on what I see? Yes, probably. The question is at what price, but I've dollar costed average down. Am I down a lot? Absolutely. Am I worried? No. My thesis still has not changed. Does that mean I'm going to be right? Absolutely not. But my goal is to make bets on 30 or 40 companies that fit the Google and Metas of the world, and overall, I will do well. So let's go check out Meta. 52-week high is 350. I think the all-time high is 382. Okay, there we go. Yep, says right here, 382.18. Let's see here. It's selling for a 5-year PE of 9.8, a 1-year PE of 9. It generated $26.4 billion in free cash flow in the last year. Look at this, guys. Look at all of these, like the EV values, EV to earnings, enterprise value to earnings. That's taking the market cap, adding in all debt, etc. Let's go to the 8 pillars. Okay, it's all 8 check marks. Does that mean we buy it? No. But I love seeing this. Very low multiples of earnings, very low debt levels, buying back shares, and they're going to continue to buy back shares, I hope, as this market falls. They're investing a lot in the metaverse. It's a $12 billion bet per year. Now, for those of you who are against metaverse, I get it. It is a risk. My comment back is if they stop doing metaverse, all of a sudden their earnings skyrocket and their cash flow skyrockets. Why is that a bad thing? Now, do I think the metaverse has some validity to it? Sure, I do. Do I think it's going to be for sure? No, of course not. I don't know what the future holds. But I do know that 3.5 billion people every single month use a Facebook product of some sort. And the other 4.5 billion people in this world, a large majority probably don't even have the money to be able to have a computer to get there. So as they get wealthier and wealthier, they're probably more likely to get onto Facebook and other things. That's a very big key here. Revenue growth, cash flow growth, net income growth, all up there. High return on invested capital. Guys, let's go look at the analyst estimates. Now, these analysts are very intimately involved with the companies. They're expected to make $10 a share this year and grow 60% over the next 4 or 5 years. Let's look at the revenue. They're expected to do 120 this year, and it's going to grow 50% over the next 4 or 5 years. Growth. It's still there. Even though their user growth is not big, they can still generate more and more revenue per user and therefore more and more profit per user. Don't get stuck in the whole, oh, they're only growing 1 or 2, 3% a year on user growth. It's fine. As long as they can still increase the revenue and profit per user as time goes on, that's what matters. Now, let's use it to go in our stock analyzer tool. Again, 10-year analysis. I'm going to go with 2, 6, and 10%. And I guess, again, I don't remember what my assumptions were in the past for Facebook Meta, but the point is it's going to be different this time because every single time I go, let me just be a little more conservative, or I might sit there and say, let me be more aggressive. I'm going to do 2, 6, and 10% revenue growth over the next 10 years. If Meta works out, that's definitely potential there. Profit margin. I'm going to go with 22, 26, and 30. 22, 26, and 30. Now, keep in mind, guys, my low number in the last 10 years, they've done 31% in profit margin and 28 to 30% in free cash flow. My middle and low assumptions are below all of that because I'm going to assume they have to spend a lot more money in the metaverse. And they're going to spend more money as time goes on. PE. Now, I think in 10 years, this company's still around and still doing revenue and profit and all that stuff higher than today. The PE of 9 is way too low. So I'm going to do 13, 15, and 17 for both price to free cash flow and PE. Because if they're right on Meta, they're going to justify a really high, they're going to own the world of social media. They're going to own the world of VR. And finally, desired annual return. I'm going to go a little more conservative here. I'm going to go 13, 16, and 19%. Hit the analyze button. So Low side 100, high side 190, middle price 140. Now you might sit there and say, Paul, what the heck? It's lower than, yeah, okay. But the question is, do I still think it's a good buy today? And according to this, I do. Does that mean you should go out and buy? Absolutely not. My decisions can be based on a lot long-term decisions. You need to sit there. I've heard all the time, people are like, oh, I put 20% of my money. Don't do that. Be conservative. Put as much money as you're willing to lose into the company. But I bought more shares the other day. I sell more puts, and I would probably continue to do so for a while, unless my thesis changes. And so far, my thesis has not changed. If you didn't see our last week's video when Meta reported, go watch that right now. Thank you very much for your time.